Good day, Industrial Advisor listeners, and thank you for tuning in. If you have not subscribed, please do so by clicking subscribe wherever you podcast. Click the like button and hit the bell if you want notifications of when we put up new content. Leave us a comment about anything we discuss here today or general comments about the show. Now, let's get into it.
All right, welcome to our Industrial Advisors podcast. We're in Boise, Idaho at the IAMC conference, and you have Bill Condon and Matt McGregor. We have Brandon Page joining us today. He's Executive Vice President and Head of Leasing at Link, which there's over 500 million feet that you guys own across the country. So you're a busy man, got a big job, and we really appreciate you joining us on the show today.
Thanks for having me here in beautiful Boise.
Boise, Idaho.
Sure.
Yeah.
Thanks for joining, Brandon. I've known you for a long time. Tell the listeners a little bit when you're not working about your family and where's home and maybe some of your hobbies.
Yeah, sure. Live in Park City, Utah, or really whatever Delta. Live at the Salt Lake Airport, I guess, in terms of flying all over the place. So do spend a fair amount of time on the road. I am a 11U baseball coach for my son. There's 5 dads that was sort of ham and egg. A lot of us travel. Yes. So we make it when we can, and that's been a lot of fun. So I got my wife of 22 years. Awesome. Daughter, 8 years old, and my son who's 10.
Excellent.
So yeah, definitely busy. Just really full-time carpooling at this point when I'm home. So
yeah,
my wife is in charge. I just sort of know my role and try to stay in the lanes and keep all the kids going where they're supposed to go.
That's right. Well, if you're coaching youth sports, I'm surprised we're going to be able to talk about anything else between you and Bill.
Yeah.
With all the coaching he does. That's awesome.
We were talking a lot of baseball before we started.
I bet.
Yeah.
Very good. Well, let's jump into the industrial sector, Brandon. Talk to us a little bit about the leasing velocity in 2023. Definitely a different year, right?
Different year. Yeah, I think the COVID rush is over, and that's probably okay. I mean, I think it was definitely not sustainable. Now, Bill and I were talking earlier. I was sitting there sort of thinking about the first half of the year and sort of had this anxiety and just, gosh, it doesn't feel great. And there's pockets, and then you step back and look, and it's like the third best year of leasing on record. So
right.
It's not 22, it's not 21. I think
that
the days of like, let's just lease it and figure it out later are over. And so there's definitely more a methodical approach. There's a lot of new construction coming online, sort of, running the headlines. But at the same time, like the markets are really good and we still have demand. And even in markets where there is a lot of new supply, we've sort of put our portfolio in a position to be a little bit more infill, a little bit more strategic, multi-tenant versus like the big bomber that's, the next big bomber out in South Dallas that's being built. So
yeah, well, it's nice. We all love, what Amazon's done for our sector, but it's nice to see all these other tenants, trying to occupy the space instead of Amazon pre-leasing everything, right?
100%. Yeah. No, I mean, look, it's just not all going to pre-lease. And even in Southern California where it's always pre-lease, it's not going to pre-lease. So we got to work a little bit harder. And I think that's a healthier overall environment for the market to be in.
That's right.
Yeah, you guys obviously have a lot of tenants across the portfolio. Are there any trends that you're seeing from occupiers this year that are different maybe from years past?
Yes, we have 10,000 tenants across our portfolio, I think ranging from probably 200 square feet in a business park building all the way to 1.5 million square feet. So we really run the gamut. I would say like our sort of core customer is in the 30 to 50,000 foot range. Mm-hmm. 3PLs still dominate the demand. I think like if you look like historically, it's been just under a third of overall leasing, and that's sort of incrementally grown every quarter, and that still remains, pretty consistent. I think, it's a cheap and quick way to sort of lease your supply chain network. So in that regard, it's definitely been, sort of that continued underbelly of demand, which is great. And I think we've seen a lot of, EV, sort of the battery belt, the whole, onshoring of manufacturing. I think it's probably happened a little bit quicker than we maybe thought, and we're actually seeing real demand. Austin's a great example of that. I mean, there's a huge amount of product being delivered there. And boy, it just feels like every other tenant that comes to that market is a supplier for Tesla looking to supply the Gigafactory. So that's been the whole Sun Belt has been a really good market for us.
Yeah, we're seeing that as well. Talk to us a little bit about acquisitions, where you guys are focused. Certainly, I would say if one thing has changed in our market in 2023 above all else would be capital markets, right?
Yeah, it's interesting. So like, the capital markets are largely disjointed. I mean, it's a really uncomfortable situation, yet the underlying fundamentals are so good. So there's a lot of capital on the sideline. Everyone's just trying to figure out like what are long-term cap rates? What is an exit cap rate? Because I think, it started to, the treasury started to drop a little bit, started to feel like you knew where things were going to be in 12, 24 months. And then all of a sudden they're back up again. Everyone goes back on the brakes. So being a Blackstone portfolio company, we're a leverage buyer, and lack of certainty around capital markets and where debt's going to be is really tough on the buy side. So, I think Blackstone, as well as Link, we all feel very good about our sector, our industry, good about the rent growth going forward, feel good about underlying demand, fundamentals, all looks awesome. It's just we've got to figure out how do we price it and how do we figure out an exit. So until that happens, your guess is as good as mine.
For sure. And what specific markets do you guys like? And are you still, buying land and land banking, or is it all still you buy that land and you're straight to development?
Most of the land sites that we own are, they're, like I said, they're not out in the cornfield ready to go. A lot of these are super tricky infill, a lot of entitlements that are needed. So, most of what we're putting in production today, we have 20 million square feet under development today. That's, those have been in process for the last 2.5 years. And there's sites that, a build-to-suit site is one and that you don't necessarily feel comfortable going spec in. And I think, fundamentally, we really like the sites that we have. And so we're moving forward. Obviously, like there's a bunch in years beyond 23, 24, just in the natural pipeline. Construction lending is really difficult right now as well. That's affecting development. But, I think, like I said, we feel good about our current development plans. Markets that we like, I'd say we're still, very, top tier markets, coastal, port centric. Southern California has been tough the last year, no doubt. But I think, like I said, we focus more on infill and nature, generally speaking, smaller bay, multi-tenant, last mile. And I think you're going to finally see a bifurcation of real estate, like Class A assets in Class A locations are going to price better than Class B. And that really hasn't been the case. It's just if you owned a building, no matter where it was, no matter what size it was, the rent all went the same. It was sort of an anomaly from what we've seen, obviously over our careers. And so I think you actually get back to a little bit more normal market where better real estate prices better. And I think, we've spent a bunch of time, obviously, buying a lot of assets over the last 5 years, but also curating a portfolio that we feel really good about longevity.
That's right. It's interesting to see everybody underwriting. Nobody wants anything over, say, a 3-year term, right? That short WALT thing has just been where all the money's at.
Yeah, it's about mark to market. And as long as rents are growing, you're actually penalized by a 10-year lease at, historical high rents when you'd rather just, if you believe in the underlying fundamentals of a market, you're better off buying something with 3 years, or less, ideally less of term, and you buy the leasing risk that was no one was concerned with that.
That's right.
Yeah, I want to circle back to the kind of the 3PL world because that is such a big part of our market in the industrial side of things. Are you seeing a slowdown? I know the 3PL world's still really active in the industrial segment, but are you seeing a little bit of a slowdown from some of those 3PL companies? Because what we're seeing a little bit is maybe not as much aggression from some 3PL companies compared to years past.
Yeah, it's a lot of 3PLs would lease a 500,000 square foot building and have, contracts for 300 and
fill it.
Just fill
it. We're going to fill it.
Yeah. By the way, like if you'd leased 10 million feet 5 years ago, your rent would be, half of what it is. And you have a competitive advantage over your peers. So I think it's definitely more, there's a little more sensitivity around the assurance of contracts and actually leasing the space that you need versus just going out and leasing whatever's available.
Yeah.
And then try to figure it out later.
Yeah. That's what we're seeing as well.
Yeah. I think you're seeing retailers pick up quite a bit, and Amazon's still moving forward with their same day, same day program, which is really pushing large retailers to figure that out. And then like the stats are real. Like if you have the ability to get something the same day or even within a couple hours, your sales go up pretty dramatically. And so these other groups have, they're 5-10 years behind Amazon in that regard. So there is definitely an underlying demand from that subset of retailers, of which flows right through 3PLs.
That's right. And Brandon, it's time to get your crystal ball out. So we're closing in on 2023 last quarter. So maybe some predictions for the remainder of this year and more importantly, 2024. What's going to change?
Yeah, I if you look at the amount of product that's being delivered between now and really the first half of 24, I think the headlines, and these are big buildings too, there's a lot of product coming online.
Yeah.
And I think, I would say like we want to own certain buildings in certain submarkets, like use Dallas, for example. We feel really good about certain submarkets and we feel really bad about another. So there is like a differentiation between the two. I think that, that it's going to be kind of rough, to be honest with you, there's just a lot of space that needs to be absorbed. Mm-hmm. However, on the heels of that, you've got roughly 50% decline in starts, and there's really nothing behind that. Right. So as long as the Fed doesn't crash the plane, as long as we sort of chew through the next 9 months, I think there's, availability. I don't know if there's really deals yet because we're still on a historical occupancy level, nearly 100 basis points below the 10-year average. So we're going into this thing like really well positioned. Small bay, multi-tenant infill, in markets like Atlanta, we were talking about this yesterday, is, call it 4 to 5%, which is still fairly landlord favored. Once you get this product that's going to be delivered, it's about 25 million feet, obviously not going to all be pre-leased. The bulk stuff, which is generally on the outskirts of town, is going to be 8 to 9%. Mm-hmm. 8 to 9% is a very different, negotiating environment than a 4 to 5%. So I think you're going to see some noise and some bumps in the headlines, which are going to be larger square footage, larger format buildings that are going to push the national vacancy up. But on the heels of that, like I said, if we can just get through this wave of deliveries, the amazingly difficult lending environment, construction lending it just stops. So yeah.
I'm curious, you said 50% less start. Is that 50% less start than last year, or is that an average of a time period?
Yeah, it was over, like from second quarter of last year, it's about 50% less starts.
It's a massive drop.
And we actually believe that number is even a little bit more inflated in terms of like what's delivering. So construction start doesn't mean I've got, a guy with a backhoe out there just pushing dirt around. And those numbers generally get thrown into the under construction. So what's really going vertical, what's going in terms of like infrastructure in the ground, we actually feel is a little bit less than that. So like I said, I think it's, the headlines aren't going to be awesome. This is going to be a roll up our sleeves and get through a bunch of supply. It's a better time, obviously, for occupiers to take advantage of the availability. And I think that's a lot of the messaging that we have to our customers. And we're hearing it from brokers as well. Is like, look, you've got probably a 12 to 18 month window to have options. And then behind that, it's going to get really interesting because the current lending environment does not allow development for the rates that we're currently in. There's only one way to go for that to make sense, and it's up.
Yeah, that's right. And on the capital market side, speaking of lending, right, it's been a historically low year from a volume standpoint. When do you think that's going to change and recover, and we're going to get back to the volume maybe that we haven't been the last 2 years, but more of a average for capital markets?
I wish I had that answer. Yeah, I'm just a leasing guy. No, I look at that's obviously the multi-billion-dollar question at this point. There's so much money on the sidelines. Banks are obviously trying to figure out where their exposures are, not necessarily on the industrial side, but there's other asset classes that sort of factor into their lending decisions. But it's certainly the most challenging lending environment that we've seen over the last 20 years. And I think getting to the point where we have some clarity on some of the exposures and risks they have in other sectors, kind of getting through whatever we believe is, whether it's a soft landing or a hard landing, is going to be important, I guess, for kind of continued health of the consumer will help as well.
Yeah, I think you hit it on the head. Clarity. Once there's some more clarity, then we'll start getting back to the normal volumes of where we've been on the industrial investment side of things.
Yeah, absolutely. And in the meantime, we're 4.2% vacancy. We have a mark to market of over 50% in our portfolio. NOI for publics as well as us are north of 10% a year. That's a really healthy underlying business to go into this.
Yeah, no, absolutely. We're in great shape on the industrial side. I think you mentioned some of the other asset classes, and industrial strength is where it is right now.
Absolutely. Yeah, I'm glad. I've been in industrial long before it was cool.
Yes,
it's nice to have our day in the sun, no doubt.
Yes, finally.
Yeah, we're the cool kids.
We're the kids. I don't know if we were ever cool, but we're.
Awesome. Well, thank you for joining us. It's been really insightful, and I hope you have a great remainder of 2023 and head into 24 with some momentum.
Yeah, you got it. Thank you guys. Appreciate you having me on.
Thank you.